The short answer is PCE did interest rates no favor today. However, they also did not crush them. What's going on, y'all? My name is Kevin Weedmark, a.k.a. the Mortgage Mouth, coming to you with a Friday episode of the Daily Dose. Very quick 2 minutes of what happened today in the marketplace and the highly anticipated PCE inflationary number that everyone was looking at did no favors to interest rates, right? So came in basically right in line. We also had, the super core, which excludes autos and gas and everything like that. That actually showed a pullback a little bit. And it showed a pullback from what we saw earlier, which was about a couple weeks ago in the CPI number. So PCE is something that the Fed looks at a little bit more closely. I like the CPI number. To me, it's a little bit more precise of what's actually going on with the economy and people and so on and so forth, and consumers in particular. However, that's what the Fed likes. So although it did nothing to really help us, and we saw that with interest rates actually creeping up a little bit today, and I don't mean overall, I don't mean like interest rates took a jump. What I mean is the yield spread premium on the backside got a little bit tighter today. And it was just essentially everyone saying, the number was okay. Didn't really do anything to help us, but it didn't hurt us as well. Coming next Friday, we have Nonfarm Payrolls. That is going to be what's going to be talked about all week, given those big revisions we had a couple of weeks ago, or at the beginning of last month. It's really going to be a clear indicator. Was that just a one-off fluke, or are we looking at some problems in the labor sector? Once again, that wouldn't be a bad thing for interest rates, because that would mean future rate cuts more than the already anticipated September rate cut, which is now sitting at over 87%. Have a great weekend. Talk to you next week. Cheers.